We have what promises to be a fascinating week coming up, with results from 3 FTSE 100 firms complementing some timely macroeconomic data. Top down, economists will be poring over the latest monthly UK manufacturing, construction and sentiment surveys, or Purchasing Managers' Indices, PMIs, not just from the UK but also the US, China and Europe as well, and they'll be doing that all through the week. Remember, a score above 50 is seen as good and indicative of future growth, one below 50 seen as bad and a potential warning about a slowdown or even a future recession. As we can see here, all 3 scores for the UK were above 50 for August, but both services and particularly construction have begun to lose a little bit of momentum, which could be a warning sign. On the other side of the pond, the highlight on Friday the 6th of October will be America's latest non-farm payroll, unemployment and wage growth figures. Barring a major collapse in jobs growth, it now seems the US Federal Reserve is intent on squeezing through 2 or 3 interest rate hikes a year and starting to reduce its quantitative easing bond buying programme. The monthly job creation data have been a bit mixed of late, as we can see here, but your benchmark for the new figure is last month's plus 156,000 number. That was a bit of a weak reading, especially as the initial estimates for the previous 2 months were revised down, and the trend over the past year does look to have been slower jobs growth. So, is the Fed making a mistake raising rates now, or is it right to do so because we are nearing peak employment and wage inflation is about to surge? Now, the figure should keep the headline unemployment rate around the 4.4% mark, although whether that's enough to spark an acceleration in wage growth remains to be seen. The average US salary increase was 2.5% year on year in the prior month to $26.39. Any pickup in the Fed may move quicker than the market currently expects, although the opposite may also hold true. Now, company-wise, possible headline makers, well, there are certainly at least 3. AIM quoted flooring specialist James Halstead. That will be looking to add to an unbroken run of dividend increases that dates back to 1975 when it reports full year figures on Monday the 2nd of October. Then there's plumbers merchant Ferguson when it releases full year figures on the 3rd. That's the FTSE 100 company that used to be known as Wolsey, by the way. And then we have Topps Tiles, whose full year results on Wednesday the 4th may give us some insight into consumer spending trends in the UK. But for me, the most likely source of a fuss in the week ahead is grocery and retail giant Tesco when it unveils first half results on the 4th of October. As we can see here, the shares are about 4% higher than they were a year ago. That compares to a 7% increase in the FTSE 100 over the same period. Now, shares in Tesco have in fairness been held back by a number of factors, including the weaker pound, in the view it increases import costs, boosts inflation, and potentially crimps consumer spending power in the process. Fierce competition from the discounters such as Aldi and Lidl, and that doesn't seem to be going away in a hurry. Concern over what Amazon may do now that it's acquired Whole Foods. And some investors still have doubts over the planned £3.7 billion merger with wholesaler Booker. It's unlikely that Tesco Chief Executive Dave Lewis will mention Booker much, not least as the Competition and Markets Authority is still assessing the deal. But when it comes to the numbers, the following 3 headline items will be important to check. First, like-for-like sales growth in the second quarter. As we can see here, June's first quarter trading statement revealed an acceleration in the UK to 2.3% year-on-year. Growth, that is, excluding VAT and fuel, although Asia did weaken. Second, look at headline pre-tax profit. In the first half last year, Tesco made 71 million on a pre-tax statutory basis, but that figure was 410 million if you felt charitable and cut out all of the bad stuff, and management will certainly steer you towards the pre-exceptionals number. For the year, analysts are looking for a hefty leap in adjusted pre-tax income from around 830 million to just under 1.1 billion pounds. And third and finally, do look at the dividend, if there is one. Disposals means net debt has come down to 3.7 billion from over 8 a couple of years ago. Whether that's enough for Tesco to resume dividend payments 2 years after cutting them to 0 remains to be seen, but for the full year, analysts are looking for 3.3 pence, so maybe there'll be a small interim as well. Watch out also for any guidance for the financial year that's just begun and progress towards the 3.5% to 4% operating margin for 2019-20. That's underpinned by £1.5 billion in further cost reductions and average capital investment of around £1.4 billion a year, although the Booker deal could affect those numbers over time, assuming the regulator lets it go ahead, of course. Thank you for watching, and I look forward to seeing you next time.